You put 20% down on a house. Ryan put every dollar he had into a stock ticker and called a plan. You stand alone in an empty living room. The keys are cold in your palm. A moving truck idles outside, engine running, meter running with it. Somewhere across town, Ryan refreshes a screen, a number climbing without him lifting a finger. Which one of you is actually going to be richer in 10 years? Everyone watching this already thinks they know the answer. Almost none of them do. Ryan bought first. Ryan always buys first. He sends you a screenshot of his portfolio, up 11% this quarter. You send him nothing back. Your house has not moved a single dollar on paper in 3 months. He laughs about it at dinner. He says real estate is for people who are scared of real growth. You say nothing. The lender's letter sits unopened in your bag. At the closing table, the loan officer barely looks at you. She stamps the last page without a word. To her, this is paperwork. To you, it is the rest of your life. Ryan was not invited to a closing table. Ryan clicked a button on his phone between meetings and called it an investment. Neither of you said the word risk out loud, not once the entire day. Here is what nobody tells you about the down payment. 20% of the price buys you 100% of the asset. That gap is called leverage, and it is the entire game. The house appreciates at roughly 4% a year historically on the full value, not on your slice of it. So the return lands on your equity, not your cash. Before costs, your 4% behaves closer to 20 on your money. That is because you only paid for a fifth of the house. Leverage works the same way in reverse, though nobody advertises that part. The bank paid the rest. The bank does not ask for a cut of the appreciation. It does ask for interest every month whether the house gains value or not. There is a second mechanic hiding underneath the first one. The rent your tenant pays does not just cover the mortgage. Part of it pays down the loan itself, month after month. Silently, the bank's money transfers into your equity. Add a tax deduction on the mortgage interest. On paper, your carrying cost is lower than the number on the loan document. None of this appears on a screenshot. None of it is designed to. You do not know it yet. The small number on the surface was never real. Ryan stocks do not work that way. His 10% average return is real. Historically, it is the strongest long-run number in the game. But every dollar of that return sits on a dollar he actually owns. No bank multiplies it while he sleeps. No leverage doubles it quietly in the background. His curve is honest. Yours is amplified. The verdict is simple. His 10% is his 10%. Your 4% was never 4% at all. The refrain lands here, and it will return. The math never lied. Only the timeline did. Ryan sells a portion of his portfolio on a Tuesday afternoon. Cash sits in his account by Thursday. You try to sell a rental unit that same month. It sits for 4 months with no offer. Liquidity is not a small detail. It is the difference between money that moves and money that waits. Ryan can leave the game whenever the number frightens him. You cannot. Your money is buried in drywall and permits. It waits on a signature that took 30 days to clear. This is the part most people never get told. You have just learned something Ryan does not know about his own portfolio. You also learned something you did not know about your own house. The winner of this game is never decided by the average return. It is decided by who survives the years the average return disappears. The tenant on the second floor stops paying rent. Not dramatically. Quietly. An excuse, then silence, then an eviction notice you did not want to file. The unit sits empty for 2 months. The mortgage keeps its own schedule, indifferent to your cash flow. Property tax arrives on time, the way it always does. The furnace fails in the same season. The repair costs more than you saved for it. You do not tell Ryan any of this. You do not know it yet. Ryan was losing in a way no screenshot could show. The market falls more than 30% in less than a year. Ryan does not post a screenshot this time. He stops answering texts about money entirely. His silence is louder than his bragging ever was. You watch his social media go quiet. Is the way a business goes quiet right before it closes. Meanwhile, your rent checks keep arriving, smaller than promised, but arriving. The house does not check a stock ticker. It does not know there was a crash. Here is the mechanic nobody warns you about at this level. A market drawdown is only a loss if you sell during it. A vacant rental month is only a loss if you cannot outlast it. The asset itself does not know your emotional state. It continues to exist while you decide whether panic is a financial strategy. Your neighbor sells his rental that same season at a loss. The vacancy, the repairs, and the rate reset all landed together. He tells you it was the responsible choice. You nod. You do not tell him you almost made the identical call the week before. Two people, two identical assets, two completely different endings, decided entirely by who blinked first. Ryan sells at the bottom. Quietly, without a caption this time. He tells you later it was the smart move, protecting what was left. You do not correct him. The antagonist looked like he was winning for 2 straight years. He has just converted a paper loss into a real one. Permanently, with one click. The refrain returns heavier now. The math never lied. Only the timeline did. This is the collapse that isn't. Your tenant finally pays months late in full. His job came back, and shame is a strange kind of motivation. Your equity, on paper, sits lower than it did a year ago. Rates move against you, and the appraiser was conservative. It looks like you are losing too. It looks like both paths have failed you at exactly the same time. You do not know it yet. This exact month is the one you will point to later. A retired man at the hardware store is buying the same furnace part you are. He tells you something you did not ask for. He says the house never once asked him how he felt about the economy. He says the investors who get rich forget they own the thing. They forget long enough to stop checking. He says it once, pays for his part, and leaves. You never see him again. You do not forget it. The math never lied. Only the timeline did. Ryan buys back into the market 4 months later. He pays a higher price than where he sold. He tells you this too, casually, like it does not matter. It matters completely. The gap between his sell price and his buyback price is real money. It will never come back to him. Your house, meanwhile, has done nothing except sit there, boring, mortgaged, occupied, existing. Verdict: an asset that cannot be sold in panic protects you from selling in one. That was never a weakness. It was the entire design. 3 years later, the numbers finally separate. Your equity compounds through leverage, rental income, and appreciation nobody noticed monthly. It has grown into something Ryan's screenshots never predicted. Ryan's portfolio sits behind where it would have been. That gap is the cost of the sell and the higher buyback, the price of not holding on. His 10% average was real. He just never got to keep all of it. You do not know it yet. The winner was decided the month you both wanted to quit. Only one of you was able to. The math never lied. Only the timeline did. The living room is furnished now. The keys are not cold anymore. Ryan calls. For the first time, he asks you a question instead of a screenshot. He asks how you knew to hold on. You do not have a clean answer. You just remember a stranger at a hardware store. And a mortgage that never once asked how you felt. The math never lied. It just took longer than either of you wanted to admit.